Welcome to Trader Talk, where we dish out the latest Wall Street buzz to keep your portfolio sizzling. I'm Kenny Polcari, and I'm coming to you live from the Yahoo Finance headquarters here in the heart of New York City, a global hub where deals are made, fortunes are built, and the next market move is always just around the corner. Coming up, I'm going to share my thoughts on capital gains versus income taxes when investing. I'm going to chat with my good friend Adam Johnson, and then I'm going to share my linguine and clam sauce recipe, the first of the 7 dishes of the Feast of the 7 Fishes for Christmas Eve. Now, let's jump into the big take. Every year, investors panic in December. They scramble to fix their portfolio, harvest their losses, rebalance, and clean up trades that they should have been thinking about months earlier. And every year, the same truth gets ignored. You don't get paid on your returns. You get paid on your after-tax returns. If you're not investing with taxes in mind, you're playing the game with one hand tied behind your back. End-of-year tax strategy isn't just some accountant trick. It's a core part of building wealth. Pros know this. They think about taxes before they hit the buy button, not after the damage is done. They ask, is this a short-term or a long-term position? What's my holding period? Does this belong in a taxable account or a retirement account? How do I offset gains without tanking my strategy? That's tax-efficient investing, and it matters. Here's what beginners need to understand. When you sell a stock for a profit in less than a year, you pay ordinary income tax, which for many people is dramatically higher than long-term capital gains. That means timing matters. Holding a great trade for just one more month could cut your tax bill in half. On the flip side, if you've got losers, and you trust me, we all have them, December is your friend. Selling those positions creates capital losses you can use to then offset the gains. That's tax loss harvesting, and it's one of the simplest ways to boost your real returns. And don't overlook asset placement. High-yield investments like REITs or bond funds often belong in IRAs where the distributions are not taxed each year. Meanwhile, index funds or long-term winners work beautifully in a taxable account because they generate far fewer taxable events. The point is not to beat the tax code. The point is to stop letting it beat you. The bottom line? The market rewards discipline, and taxes reward planning. Don't wait for December to start thinking like a professional. Build a tax strategy into your investing all year long so at the end of the year, you end up with more in your pocket and less donated to the IRS. It is my pleasure once again to welcome back my good friend Adam Johnson, who all of you know. Adam manages the American Ingenuity portfolio at Bullseye Investment Group, and he writes the Bullseye Brief, his weekly investment letter highlighting standout U.S. innovators and growth leaders. Before founding Bullseye, Adam anchored daily business programs interviewing CEOs, policymakers, Nobel laureates, and top investors. He spent decades on Wall Street trading stocks, options, and oil at ING Asset Management, Louis Dreyfus, and Merrill Lynch. He's a Princeton-trained economist, and he brings a sharp, optimistic lens on where American innovation is heading next. It's always great to have him back with me. I'm always enjoying my conversation with him. Ladies and gentlemen, please welcome joining Adam Johnson. Adam, it is a pleasure.
Kenny, thank you.
It's a pleasure to have you. Thank you for coming back. And by the way, congratulations on your recent marriage. That's great.
Thank you.
Beautiful. You look good. Marriage agrees with you.
I feel good. I don't know what I was waiting for, why it took so long, but
Well, you had to find the right one, and you did.
Yeah, I did. Oh,
yes, you did.
She's fantastic.
She is. All right, so listen, let's get right to it, right? Because it's all about the AI mania. Now, you run a fund called what's it called?
The American Ingenuity Fund.
Okay, and it's all about
American Ingenuity, which I describe as the U.S.-based people, companies, and technologies driving the world forward.
Okay, and so a lot of that then includes technology, AI.
Yeah.
And so let's do an AI mania reality check,
yeah, sure.
Right? Because we certainly know how the market has acted this year. We've seen all these stocks trade incredibly well and have great performance. And people talk about, are we in a bubble or are we not in a bubble? I'm in the camp that we're maybe a little bit stretched, but I am not in the camp that we're in a bubble.
Well, I think there are 3 myths that we can actually debunk. Myths that have been kind of hanging over the AI stocks over the past several months. A lot of them have come down quite a bit, 30-40%.
Yeah.
Right? Since September. So number one is that all these companies, all these AI companies, and even companies in general are spending way too much money and they can't afford it. That's myth number one. Let's debunk it. If you actually look at the averages, the average S&P 500 company is spending 1% of revenues on AI. 1%. Kenny, that's nothing. Now, even if you say, yeah, but hang on, what about the Mag 7, Amazon, Google, Meta, et cetera? They're spending 20%. Yeah, you're right. They're spending 20% of their revenues, 1/5, on AI investment. Gosh, that's a lot. Yes, it is, but they're growing their revenues at 30 to 35%. They too can afford it. So, myth number one debunked. Companies are not spending too much on AI. It takes money to make money, and they can all afford it. Myth number two, the AI stocks are somehow trading in a bubble. No, they're not. Think about this, Kenny. The NASDAQ right now trades at about 35 times earnings.
Right.
In previous bubbles like 2008 and 2001, the tech .com thing.
.com bubble, which was a bubble.
Which was a bubble. PE ratios were 75, 80, 90 times. Again, today we're at 35.
Right.
So those were bubbles. What we're seeing right now, not a bubble. And the S&P 500, by the way, trading at about 21 times forward. That's right within the range of, call it 17 to 24 times that we see in bull markets. And the S&P, I should point out, has had 4 consecutive quarters of double-digit gains with record margins. So I'm very comfortable with valuations. Myth number two is debunked. And then the third myth, that somehow China is eating our lunch. Right. Well, hang on. China's DeepSeek, if you remember, was announced 9-12 months ago, and it crushed NVIDIA for about a month. And then we got over it because what we learned was that China's DeepSeek was built on the backs of 2,200 NVIDIA chips and code stolen from ChatGPT. Right? So the Chinese are just copying what we're doing, which means they're not going to replace us. They're trying to play catch up. So myth number three debunked. I think that as we get closer to the new year, people are going to start realizing what you and I are talking about, that these are myths, they are not realities. And as a result, they are going to start taking the AI stocks higher again. And as that happens, the entire market will rally.
Right. Okay. So first of all, I gotta say, this is why I love you, because you're so clear, you're right to the point, and it makes complete sense, everything you say.
Oh, thank you.
And I'm glad, and I think the listeners will appreciate that, right?
I hope so.
Because I think you did debunk all those questions. Here's my question, though. While I think that they can go higher, because I think we're very early innings, we're even
agreed.
We might still be in the batting cage. I'm not even sure we started the game yet, because I think it's a long runway.
Runway.
Should we see or could we see a pullback in 2026? Actually, would it be healthy to see a pullback in some of these names?
Oh, I can answer that question very easily. Yes, of course we'll see a pullback, Kenny. In fact, we've just had a pullback. In case no one had noticed, over the past several weeks, we saw the S&P 500 fall 6%, the NASDAQ fall 8%. My portfolio fell even more than that because I'm a growth investor.
Well, because individual names, and to your point, and I saw you this morning on Stuart Varney, Marvell Technologies was down 40%.
Yeah.
From
actually more than that.
From its high to
from $130 down to 55. And it's now back to 100. In fact, I think you got to own Marvell. It's part of that essential AI tech stack. Marvell, just for our viewers, so they know if they haven't heard of Marvell, MRVL is the ticker. This company makes semiconductors that help regulate the data storage for large AI platforms. So, you've got NVIDIA that does the calculations, but you need Marvell to actually manage all the data. And they recently made an acquisition that is going to help them manage data more efficiently. So it's one of those must-own names within the AI ecosystem.
Okay, that's interesting. I didn't realize that. I didn't realize that. That's very interesting.
Very specialized.
Yeah, it's very specialized. Yeah. Who else is in that sector?
Well, they're number one for database storage. But what I think you have to do as an investor, and what I do in running the American Ingenuity Fund, is I look at the ecosystem, right? So as one of my early mentors said, how do you make the most amount of money on Wall Street? The answer, find a theme and leverage it. AI is the most powerful theme of our generation. And so you say, great, how am I going to leverage that? Well, you want to own the ecosystem. You want to own Marvell. You want to own NVIDIA. You want to own CoreWeave, which has turned AI into a service. CoreWeave will rent AI capacity to you over the cloud. And CoreWeave has partnered with a company called Applied Digital, which actually owns and builds data centers. So Applied Digital would be part of the ecosystem, right?
Right.
And then Sterling Infrastructure builds them. That's the company that actually builds them. GE Vernova powers them
Right.
by generating electricity on site. So again, if you're thinking about AI, it's not just NVIDIA; it's the
Right.
whole ecosystem.
It's the whole ecosystem, and it's derivative, right?
Yeah.
What you might call derivative plays, right?
Yeah.
What about NuScale? Because that's a small nuclear reactor that
Yeah.
also powers. So that's also part of the ecosystem.
It is, but I don't own it, although the stock has come way down. I think it's gone from like 50 to 20.
Yeah.
SMR, I believe, is the
Yeah,
ticker.
yeah.
Small modular reactors, and so hence the ticker. That's cute, right? Nice tie-in. And so the company's down about $20, and you say, oh, it's got cut in half. Here's the catch: they don't really have any revenues. They certainly don't have earnings. And maybe if you go out to 2028, they'll be able to generate $750, $800 million in revenue, because at that point, the projects will be coming to fruition, right? You build a small nuclear reactor like what you have on a nuclear submarine, right? But instead of powering a sub, it's powering a factory, a data center.
Right.
These things take a long time to, it's a long cycle product. You have to find the land, you have to get it approved,
Right.
get all the regulations done. You have to hire the company that will actually build the thing for you. You have to build the components, you have to assemble it, you have to test, right? It takes a long time.
Right.
And so because this is technology that's been around for a long time, the military's been using, but it's still new to the commercial sector, it's not really proven, and the process isn't streamlined yet. So if you're going to buy that company or any of the others in that space, you just going to have to be patient. It's kind of like a biotechnology.
Yeah.
I mean, they've got this promising drug, but it could take 3-4 years to prove that it works.
Right. And it is to your point, it is a volatile name. If you look at it on the chart, you see, right?
Yeah.
It's got these dramatic moves. And to your other point, I just want to go before I move on I want to talk about kind of Bitcoin, but before we get there. To your point, over the last couple of weeks, we have seen a little bit of a pullback. Marvell was down 40%. NVIDIA was down about 17%, I think.
Sure.
Microsoft, they were all down. What I noticed is they all came right down and kissed the long-term trend line and found support there and have since bounced.
Perfect.
Right? Which actually I think is what you want to see.
Yeah.
Well, the reason I ask is, are we going to see another drawdown in 2026? Because it's a midterm election year, and that always creates chaos and confusion, at least in the first half of the year.
There are typically 2 to 3, 8 to 10% pullbacks every year, Kenny. So if you ask me, are we going to see a pullback in 2026?
Right.
Yeah, of course we will, because we always do.
Right.
And guess what? People are going to say, "Whoa, geez, you think it's over?"
Right.
Gosh, I don't know, Adam. I mean, this could be it. No, this is not it. This is just another pullback.
Right. And I find that that's always very interesting, because you always get people that start to get a little bit nervous because everyone's expecting it to happen, right? This has to be it. Like, that has to collapse now. No, it doesn't. It's a healthy pullback.
That's
I think, in markets. And once again, I always say to clients, look, you're in high quality names. You're not in these names that are way out in the risk scale that are going to cause you angst.
Right.
You're in high quality names and the fundamental story hasn't changed. Okay, so the market's having a drawdown. Story hasn't changed.
That's
so
right.
You would actually use that as an opportunity.
Yeah, the worst thing that can happen is you get panicked on the way down. And then what happens?
Which is what
you never have
happens.
the guts to go back in.
Well,
You say, well, there's this and there's that.
And so that's what happens. They get panicked on the way down, and they get out, and then and then the market stabilizes, it runs back up, and then they get all flustered, right?
Right. And they said, gosh, I lost on the way down and I missed on the way up. Now what?
Right. Now what is you don't make emotional decisions.
Right.
All right, hold that thought 1 minute. We're going to take a break. We'll be right back. Let's talk about Bitcoin and where you think, first of all, its action, right? It had a dramatic move down from 125,000 all the way down to 80,000.
Yeah.
Had a significant move, broke through all three trend lines, is now into bear market territory. But talk about that risk sentiment and how you think it affected maybe, or maybe not affected, the psyche on the market.
Well, it's another whoop-de-doo movement.
Right.
Right? I mean, Bitcoin is very volatile. You just said it went to 125 and then pulled back to kind of 80.
80.
Well, guess what NVIDIA did about a year ago? It went to 135, which at the time was a new all-time high, and it pulled back to 85.
That's right.
And then what did it do? It went to 200.
Right.
So the notion that pullbacks are somehow harbingers of the end is just completely absurd.
Well, I think the confusion, not the confusion. I think the concern is is Bitcoin real? Like, NVIDIA is a product. It's a real company with a product. Microsoft, the same thing.
Yeah.
Bitcoin, everyone always has that question. What is it? What does it do for me? Is it really real? So
Yeah.
when it has a drawdown like that, it creates all this anxiety.
Yeah, of course. So I think that we, and by we I mean sort of everybody, I think we spend far too much time talking about the price of Bitcoin as opposed to the mechanics
That's right.
of Bitcoin.
I agree.
And truth be told, actually, there are some tools out there that have better mechanics, like specifically the US dollar-backed stablecoin, which has been issued by a company called Circle, CRCL. IPO'd back in June at 31 bucks, did a moonshot to 300, has since pulled back to 75. I actually recently just bought it. And the stablecoin that they've created, USDC, US dollar coin, is backed by treasuries 1-for-1. So let's say you wanted to transfer your Bitcoin, because Bitcoin's so volatile. I mean, you get all stressed out.
Yep.
You want to keep money in your crypto wallet, but you can't keep US dollars in a crypto wallet. You can only keep crypto in a crypto wallet.
Right.
So you convert your Bitcoin to USDC. Well, USDC is pegged to the dollar.
Right.
And it's backed by the dollar. So if you buy some USDC, the issuer, Circle, is going to go out and buy treasuries 1-for-1.
Right.
And the treasuries sit in an account, in one account, their account, and then the USDC sits in another, your account, and they balance. So your value is locked in.
Yeah, but you've now traded your Bitcoin for the USDC.
Correct.
So now you have no Bitcoin exposure.
You have no, which you might actually welcome because Bitcoin is so volatile. You want to have Bitcoin perhaps as an investment or perhaps for money transfer. But guess what? Actually, for money transfer, USDC is much better because it's stable.
Right.
It doesn't move.
Right.
And it's guaranteed. It's backed by treasuries. So and it trades 1/4 the volume of Bitcoin. I mean, that's pretty big. It's already trading 1/4 the volume of Bitcoin. So it's a actual store of value and a faster, easier, more reliable way to transfer money because it's backed by Coinbase, JP Morgan, Apollo, et cetera.
Right. So it's good for the money transfer part of it. But as an investment, it's not nearly right.
Because it doesn't move.
It doesn't move.
Correct.
Doesn't move.
It just sits there. It's
right.
like literally a stack of hundreds on a shelf. But sometimes a stack of hundreds on a shelf is a pretty good thing.
King. Yeah, right. Wait, let me ask a question. You own Bitcoin?
No, I do not.
None of it.
But I own Coinbase, and I now own Circle because I just bought it.
Right. Okay. So you have.
And I own CleanSpark, CLSK is that ticker, which is the lowest cost Bitcoin miner, number one. They make money, trades at 8 to 10 times earnings. And number two, they because they operate their own data centers that are powered by very low energy sources, cheap energy, they are now converting some of their excess Bitcoin mining capacity to AI. So they're now an AI data center trading at 8 to 10 times earnings. So CleanSpark is actually very interesting because it's both crypto and AI, and it's cheap.
CleanSpark.
Yeah, CLSK.
I'd not heard of that.
Yeah, it trades $12, $13. It's
is it
cheap.
new?
No, it's been around.
Let's talk about kind of some of the biggest moves as we reflect back on 2025.
Yeah.
Some of those biggest moves that maybe we didn't expect or they happened. And, we talk about tariff tantrum, right? Back in April, right? When the market had a complete meltdown and, oh my God, this is it. The world is
That was
over.
stressful.
Well, it was stressful. And clearly the market had dramatic moves lower over a very short period of time.
Yeah.
But then we found, people kind of took a step back from it and found some stability, and it's been nothing but up ever since.
Well, I wouldn't say it's been nothing but up. I mean, my AI names, as noted, over the past 6-7 weeks, have all taken hits, but they're all reinflating.
Right, but that's specific to you and the type of fund you have,
Correct.
right? So yes, yours is going to be more volatile. But if I look at my own personal portfolio, right?
Yeah.
I have exposure. Was I down when April happened? For sure. But now the market's at all-time highs and my account's at all-time highs.
Yeah, perfect.
Right? So it works the way that it's supposed to work.
Yeah, that's right.
Tell me what you think the next Fed action is going to be in 2026. We know in December they're going to cut rates. I get it. ADP came out with a negative number. The capacity utilization is kind of soft. That worries me a little bit in terms of manufacturing. But tell me where you think we are in 2026.
Well, on the assumption we get a rate cut in December in what is it, 2 weeks, a week and a half, whatever it is. Great. Then we look to the next year. If you look at Fed fund futures, and they're very volatile, they're pricing at least one cut by April.
But let me ask you a question, because I'm in this camp where I hear you.
Yeah.
But you do have to be careful about overstimulating. I mean, look,
Yeah.
by the end of December, rate's going to be 3.5, 3.75,
Right.
which is smack right in the middle of historical range.
Sure.
Where do you think they're going? At 3%?
3.25.
Okay, so that's one more quarter basis point cut.
Right.
That's all that is.
Right.
Right? And I'm not even sure we need to go there, but okay, I'll give it to you. Beyond that, I think you have to really start to worry about overstimulating, and then you're going to see inflation take off. Again, I hate to bring it up, the way it did back in 1979, 1980, when they thought they beat it,
Right.
and then they cut rates, and boom, inflation actually surged higher than it did the first time.
The Fed is a gradualist Fed
Right.
under Chairman Powell.
Under Powell, but that may not be the case under Hassett.
Just to sort of close the loop on rates, think about what 50 to 75 basis points of cuts would do for mortgages. Wow, what a gift. Home equity loans, student loans, car loans.
Right. But
Big.
okay, but that
boost
could
in the arm.
also cause housing prices to surge again, right? Which is you
Yeah.
have to be careful.
Yeah,
right?
They might.
Right.
Yeah, housing prices could surge. And the reason we care about that is that housing is 1/3 of the CPI calculation.
Right, but they're already screaming about affordability. That's going to be the theme in the midterm election. And
Of course.
certainly housing is going to be the top of the line. People can't afford it. They can't afford
Well,
it.
the reason that housing prices are so high is that there are very few homes for sale because no one wants to give up the 3.25% mortgage that they locked in 5 years ago.
That's only the conversation.
Way too long.
We can pick that up at the next conversation we have. In the meantime, it's time to introduce the first dish of the Feast of the Seven Fishes on Christmas Eve. It's linguine and clams, and is one of those iconic Italian dishes that proves simplicity is the ultimate luxury. It's the marriage of these briny, sweet little necks with garlic and white wine and crushed red pepper and the silky tears of the gods, which is the pasta water, that ties it all together, right? The sauce is light, it's ocean-kissed, it clings to every strand of linguine like it was born to be there. And for me, this dish isn't just dinner, it's tradition, right? Because I serve this as one of the 7 fishes on Christmas Eve in what we call the Feast of the Seven Fishes on Christmas Eve, because it sets a tone for the entire night. It's clean, it's fresh, it's bright flavors that wake up the palate and really honor the sea. Now, you can scan the QR code on the screen for the full recipe, and trust me, you will thank me later. That's a wrap for today's Trader Talk, but the conversation continues. Subscribe on Apple Podcasts, Spotify, Amazon Music, or wherever you get your podcasts. You got questions or topics you want covered? Email us at tradertalk@yahooinc.com, because we're always listening. Until the next time, stay sharp, stay disciplined, stay in touch, and take good care.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.